Hi there, this is Andy from Totally Forex, and in this video we will go over Forex market basics, such as what is Forex, how it works, what moves the markets, and other key concepts you must know prior to trading. Forex or foreign exchange can be explained as a network of buyers and sellers who transfer currency between each other at an agreed price. It is the means by which individual, companies, and central banks convert one currency into another. If you have ever traveled abroad, for example, then it is likely you had to exchange your currency to the currency of that country, thus you have made a forex transaction. Currencies are important because they allow us to purchase goods and services locally and across borders. International currencies need to be exchanged to conduct foreign trade and business. If you are living in the United States and you want to buy a car from France, then either you or the company from which you buy the car has to pay the French for the car in euros. This means that the US importer would have to exchange the equivalent value of US dollars into euros. While a lot of foreign exchange is done for practical purposes such as the ones we just described, the vast majority of currency conversion is executed with the aim of making a profit. The amount of currency converted every day can make price movements of some currencies extremely volatile. It is this volatility that makes Forex so attractive to traders, as it creates a greater chance of high profits but at the same time increasing the risk. Unlike stocks, commodities, or cryptos, Forex trading does not take place on exchanges but directly between two parties in an over-the-counter market. The Forex market is run by a global network of banks spread across four major Forex trading centers in different time zones: London, New York, Sydney, and Tokyo. Because there is no central location, you can trade Forex 24 hours a day for 5 days a week, with the exception of some holidays. There are three different types of Forex market. The spot Forex market, which is the physical exchange of a currency pair and takes place at the exact point the trade is settled, on the spot, or within a short period of time. The forward Forex market, in which a contract is agreed to buy or sell a set amount of a currency at a specified price to be settled at a set date in the future or within a range of future dates. And last, the future Forex market, in which a contract is agreed to buy or sell a set amount of a given currency at a set price and date in the future. Unlike forwards, a future contract is legally binding. Most traders speculating on Forex prices do not plan to buy the currency itself. Instead, they make exchange rates prediction to take advantage of price movements in the market. A base currency is the first currency listed in a Forex pair, while the second currency is called the quote currency. For example, in the Euro versus USD pair, Euro is the base currency and US dollar is the quote currency. Forex trading always involves selling one currency in order to buy another, which is why it is quoted in pairs. The price of a Forex pair is how much one unit of the base currency is worth in the quoted currency. Each currency in the pair is listed as a three-letter code, which tends to be formed by the two letters that stands for the region and one standing for the currency itself. For example, Euro versus USD is a currency pair that involves buying the Euro and selling the US dollar. So in the example, Euro is the base currency and USD is the quoted currency as we mentioned earlier. Now, if Euro versus USD is trading at $1.11626, then 1 euro is worth $1.11626. If the euro rises against the dollar, then a single euro will be worth more dollars and the purse price will increase. If it drops, the purse price will decrease. So if you think that the base currency in a pair is likely to strengthen against the quoted currency, you can buy the pair going long, and vice versa. If you think it's going to be weakened, you can sell the pair going short. To keep things in order, most providers split pairs into the following categories. Major pairs, which include 7 currencies that make up of 80% of the global Forex trading, and those are Euro versus USD, USD versus GPI, GBP versus USD, USD versus CHF, USD versus the Canadian dollar, and the Australian dollar versus the USD. Minor pairs, which are less frequently traded, often feature major currencies against each other instead of the US dollar, includes Euro versus GBP, Euro versus CHF, and GBP versus GPI. Exotics, which are a major currency against one from a small or emerging economy, includes USD versus PLN, which is the US dollar versus the Polish zloty, GBP versus MXN, which is the sterling versus the Mexican peso, and Euro versus the Czech Republic koruna. And last, regional pairs, which are the pairs classified by region, such as the Scandinavia or Australia, includes Euro versus Norwegian koruna and Australian dollar versus the New Zealand dollar. The Forex market is made up of currencies from all over the world, which can make exchange rates predictions difficult as there are many factors that could contribute to price movements. However, like most financial markets, Forex is mainly driven by the forces of supply and demand, and it is important to gain an understanding of the factors and influences that drive prices. Those are, first, we have the central banks. Supply is controlled by central banks who can announce measures that will have a significant effect on their currency prices. Quantitative easing, for instance, involves injecting more money into an economy and can cause its currency price to drop, something we have seen quite a lot during the pandemic. Second, news reports. Commercial banks and other investors tend to want to put their capital into economies that have a strong outlook. So if a positive piece of news hits the markets about a certain region, it will encourage investment and increase demand for that region's currency. Unless there's a parallel increase in supply for the currency, the disparity between supply and demand will cause its price to increase. Similarly, a piece of negative news, like the war between Russia and Ukraine, can cause investments to decrease and lower a currency's price. This is why currencies tend to reflect the reported economic health of the regions they represent. Third, market sentiment. Market sentiment, which is often in reaction to the news, can also play a major role in driving currency prices. If traders believe that the currency is headed in a certain direction, they will trade accordingly and may convince others to follow suit, increasing or decreasing the demand. Fourth, economic data. Economic data is integral to the price movement of currencies for two reasons. It gives an indication of how an economy is performing, and it offers insight into what its central banks might do next. Say, for example, that inflation in the Eurozone has risen above the 6% level, and the European Central Bank aims to fight it. To do that, the European Central Bank main policy will be to increase European interest rates, so traders might start buying the euro in anticipation of rates going up. With more traders wanting euros, euro versus USD could see a rise in price. Fifth, credit ratings. Investors will try to maximize the return they can get from a market while minimizing their risk. So alongside interest rates and economic data, they might also look at credit ratings when deciding where to invest. A country's credit rating is an independent assessment of its likelihood of repaying its debts. A country with a high credit rating is seen as a safer area for investment than one with a low credit rating. This often comes into particular focus when credit ratings are upgraded and downgraded. A country with an upgraded credit rating can see its currency increase in price and vice versa. There are a plethora of different ways that you can trade Forex, but they all work the same way, by buying one currency while selling another. Traditionally, a lot of Forex transactions have been made via a Forex broker, but with the rise of online trading, you can take advantage of Forex price movements using derivatives like CFD trading. CFDs are leveraged products which enable you to open a position for just a fraction of the full value of the trade. Unlike non-leveraged products, you don't take ownership of the asset, but take a position on whether you think the market will rise or fall in value. Although leveraged products can magnify your profits, they can also magnify losses if the market moves against you. Now let's have a drive on major terminology around trading Forex, like spread, lot, leverage, margin, and pip, as it is essential you understand these terms prior to trading Forex. So, what is the spread in Forex trading? The spread is the difference between the buy and sell prices quoted for a Forex pair. Like many financial markets, when you open a Forex position, you will be presented with two prices. If you want to open a long position, you trade at the buy price, which is slightly above the market price. If you want to open a short position, you trade at the sell price, slightly below the market price. Moving on what is a lot. Currencies are trading in lots, batches of currency used to standardize Forex trades. As Forex tends to move in small amounts, lots tend to be very large. A standard lot is 100,000 units of the base currency. So, because individual traders won't necessarily have £100,000 or $100,000, for example, to place on every trade, almost all Forex trading is leveraged. And since the word leverage mentioned, let's dive into it. Leverage is the means of gaining exposure to large amounts of currency without having to pay the full value of your trade up front. Instead, you put down a small deposit known as margin, and when you close the leverage position, your profit or loss is based on the full size of the trade. Another major term is margin. Margin is a key part of leverage trading. It is the term used to describe the initial deposit you put up to open and maintain a leverage position. When you are trading Forex with margin, remember that your margin requirement will change depending on your broker and how large your trade size is. Margin is usually expressed as a percentage of the full position. So, a trade on Euro versus USD, for instance, might only require 1% of the total value of the position to be paid in order just for it to be opened. So, instead of depositing $100,000, you'd only need to deposit $1,000. Last and equally important, what is a pip in Forex? Pips are the units used to measure movements in a Forex pair. A Forex pip is usually equivalent to a one-digit movement in the fourth decimal place of a currency pair. So if Euro versus USD moves from $1.11530 to 1.11540, then it has moved a single pip. The decimal places shown after the pip are called fractional pips or sometimes pipettes. Forex market is quite fascinating, and the most amazing thing about Forex is that approximately $5 trillion worth of Forex transactions take place daily, which is an average of 220 billion per hour, making Forex the world's biggest and most liquid financial market. If that's not exciting, I don't know what it is. Thank you for watching our video about Forex. Please like, subscribe, and leave a comment about your experience or questions regarding Forex trading.